So lately in the markets, we've seen a lot of payment processing companies take a bit of a dip. So here we're looking at the chart of Visa, which is the company we're going to look at today. And as we can see, this is the past few years. They dipped like most companies during March of 2020. They then had a pretty solid run up in the next 18 months, but lately they've actually come down quite a lot, about 10%. And if we take a look at PayPal here, we can see kind of a similar pattern, except PayPal had a much higher run up throughout the course of 2020 and then into 2021, but they've come down a lot since then, even more so than Visa. And then if we take a look at MasterCard, a company very similar to Visa, a similar pattern, but not quite as accentuated as what we saw here with Visa. So a big reason for this is more fears of this impending Omicron variant taking place, primarily as it relates to travel restrictions. If we're talking about Visa, because that could limit their international fee processing revenue, which is a big source of growth for them. But also, I think the valuations of these companies were a bit stretched to begin with before this fear took place. So I think this is a reasonable correction. So what we'll do in this video is what we usually do when we take in-depth looks at companies, which is we talk about the company itself, how it makes money, its strategy. We'll talk on the competition as well. And then we'll conclude by doing a discounted cash flow analysis of Visa with the goal of determining what future scenarios of revenue and cash flows are currently priced into Visa at this valuation, and then determine if we agree with those scenarios, and we can make a decision based on that. So we'll start by taking a look at some quick valuation metrics of Visa. So we'll start with the price to sales ratio, and we can see currently the price to sales ratio is 19.23. Now, despite the recent pullback that Visa had, this is actually still higher than the 5-year average. So still, if you're looking at it in terms of sales, it is historically expensive. And then if we want to look at it on a price to earnings basis, it's about in line to where it's been in the past 3 years. And if we go back and look at previous years, it's actually a bit higher than what it was in 2013, 2014, 2015. So clearly Visa is a company that has become more in favor throughout 2021, as well as going back to 2020. People see more growth potential in this company as evidenced by this higher multiple. So before we go any further, let's actually get into what Visa does. What's the value that they provide as a business? Obviously, everyone's heard the name, but I bet there's not as many people who fully know what Visa is. For example, they don't issue credit cards, actually, nor do they earn interest from offering credit to consumers. That's what the banks do. The primary way that Visa earns its money is through the Visa network, which is called VisaNet, and it facilitates transactions. So here's a quick example of how authorization of a payment works. So you'll notice you have a few different players in the market, and it kind of has its own language. So I'll go through each one here. So you have the card holder, which is the person who's buying something. We could say from the merchant, and the merchant would be the person who's selling something in this example. And then you have the acquirer, which refers to the financial institution that is used by the merchant. Then you also have the issuing bank, which is the financial institution that has issued the credit card. So they've given the credit card to the holder, which in this case is the person making the transaction. So when a transaction gets initiated, of course, what needs to happen is money needs to be sent from one bank account to another. So payment processing, all it is the process by which a transaction gets authorized. So those are the 4 players. And then you also have card associations, which is what Visa and MasterCard would be. So they're just the networks. All they do is transmit data between the banks, and they collect a small portion of the fee. It really comes out of the merchant's pocket at the end of the day. But you could also make a case to say that they earn their money by providing access to their Visa network, which helps them grow their business because a lot of people already accept payment through Visa. So it's a way to grow the business further because so many people already accept it as a method of payment. So really the value that Visa provides as a business is in the network itself. They're just a network that's used by these 2 parties to transact with each other. And because there's so many acquirers, that is the merchant's financial institution, and issuing banks, which is the cardholder's financial institution that already accept payment via the Visa network, that they often have no choice but to just do the same and also accept payment through Visa because so many people already use it. And it's that network effect that really gives it so much value. And really, people have no choice but to use Visa just because it is such a common way to pay for goods and services. And in addition to that, the Visa network has historically been pretty reliable. So that's also another reason why it's become so popular. So now if we take a look at the Visa 10K, and we can see that they divide their revenue into 4 categories, which are data processing revenue, and that refers to what we just went over, which is the authorization, the clearing, the settlement of transactions. Now, this depends on the volume of transactions and not necessarily the size of those transactions. Whereas if we take a look at service revenue can actually increase depending on the size. So those are the fees that are charged to financial institutions for the use of the Visa network. So more dollars flowing through the Visa network means more revenue in this segment. And the reason I wanted to point this out was because we can always expect this to at least grow at the rate of inflation as long as Visa remains a dominant player in the payments industry, which I think for the foreseeable future makes sense to assume that as well. So that's going to be important when we build that into our DCF model and we look at forecasting the perpetual growth rate, because we know that approximately a third, I mean, it may change in the future, but approximately a third of their revenue is currently coming from the service revenue, which we can assume will continue to grow at least at inflation. Now, we can't say the same for data processing revenue because that just depends on payment volume and not necessarily payment size. So it's important to keep that distinction in mind. And then we also have international transaction revenues. And this, I think, is going to be a key source of growth for Visa because they generally earn higher fees on these transactions because they can charge higher fees. And we can also see other revenues, which could be for a variety of reasons. And then this negative number, which is how we arrive at net revenues, which accounts for all 5 of these categories, is client incentives. So that's kind of how they're reinvesting back in their network, is through the client incentives, because they need to incentivize people to continue to use the network or to join the network, because that's what makes it more powerful and gives it so much value. Now, you may be also wondering, what's the difference between different services like MasterCard, PayPal, American Express when compared to Visa? So Visa does compete with MasterCard because MasterCard is also a card network that essentially performs the same function. And they're both open loop networks. And the opposite to that would be a closed loop system, which is what American Express is. So American Express, they do operate a payment network similar to Visa and MasterCard, but they're also a card issuer. And Visa and MasterCard are not card issuers. So American Express actually earns interest from offering credit to people who use their services. And here we can kind of see the number of transactions that each different service has offered on a global scale. So Visa is the number one. This is as of 2020 here. Now the gray here would be Union Pay. So that is China. And then MasterCard, or the blue would be Union Pay, and that's China. And then gray would be MasterCard. So Visa is currently the largest, and then Union Pay, which is just China. And then MasterCard would be third largest. And then we can see American Express. They didn't have data for 2020 here, but it's not quite as big as Visa and MasterCard at present time. Now, if we're talking about PayPal, Visa does and does not compete with PayPal. It's a little bit complicated. So Visa and MasterCard, as we discussed, are networks, while PayPal is really just an online portal for making payments. And it's good because you don't have to enter your credit card info into all these different sites. You can just pay through PayPal, which it's secure, it's encrypted, so it's much easier. And you can use both PayPal and Visa simultaneously when making a purchase online. For example, if you pay with a Visa credit card, then you could pay through the PayPal portal, but then the transaction gets routed through the Visa network. But you could say that they compete indirectly. Now, we know that Visa wants as much of the transaction pie as they get. They want transactions flowing through their network. So if a transaction just takes place on PayPal, for example, say you have money in your PayPal account and then you just pay using that, in that case, it wouldn't go through the Visa network. So in that sense, they are competing with each other. And then there's also many different miscellaneous services that all these different companies offer, which is a lot more complicated to get into. Okay, next thing I want to get into is to talk about the payments industry. So what trends are developing in this industry and how do those relate to Visa? So I think probably the biggest tailwind for Visa, so the thing that could propel them forward, is quite obviously the growth in cashless payments. This would probably be the largest, especially when you're talking about international markets, as cashless payments become more prominent in third world countries, and not even third world countries, but just countries outside of North America. You can expect to see a lot more transactions going through the Visa network, which obviously would increase their revenue. So this was a pretty interesting study I found on the topic. It was written by McKinsey, their consulting company, and it's a pretty comprehensive study. So comparing 2020 or 2010 to 2020, And they're looking at the total percentage of transactions where cash is used in various countries in 2010 versus the same number for 2020. And obviously you can see it decreasing, which means cash is being used less. So if you look at Japan here, 79% in 2010 were transactions where cash were used, and now that's down to 54. And across the board, you can see Korea, same story, Singapore, and these are the mature markets. And then if you look at emerging markets, still many of them still use cash for a lot of their transactions. And I think as the technology spreads throughout the world, we can expect to see these numbers decline a bit, which Visa being the largest network as it is and having that network effect work for them is probably going to see a lot of benefit from this. Now, another tailwind for Visa is the growth in their international transaction processing revenue. So here what I've done is I've taken their revenue breakdown for the last several years and looked at it as a percentage. So let's look at the international transactions. So in 2013, it was here 28.77%. And we can see it kind of decrease throughout or increase throughout the years. So 28%, 29, 30, 34, 35, and then about 34 again. And then in 2020 and 21, it decreased. Now, we obviously know why that was. There were a lot of travel restrictions that were implemented in those years, which means less people are traveling. So you're going to have less people exchanging money across borders. And what I also want to point out is the effect that this had on their operating margins. So Visa's operating margins, if we go back, I'm going to extend this for a few years. So we can go back and look at many years of historical data here. So operating margins in 2009 were 51%. And then we can see them increase to 65% in 2015. And then they still increase from there, but they kind of stop in 2017 when they hit 67%. 2019, they're 67% as well. And then in 2020 and 2021, they fall back down. So I think one of the drivers of that was the lower volume of international transaction processing. So if the trend that we were seeing here continues, once the travel restrictions are officially gone and things go back to normal, which is hopefully soon, then we can expect to see this go back up to where it is, which is 34%, which would likely mean their operating margins get back to the level of 2018 and 2019 of 67% as opposed to 64, 65%, which may seem little, but when we're building that into a DCF model, operating margins is a big input into the DCF model. So it's really important that we get this correct and we actually accurately predict what it'll be. And I think it does make sense to assume that it will revert back to where it was previously and probably continue to grow if the international transaction processing revenue continues to grow like it was before. Okay, so we talked about the good stuff happening in the industry. Let's also touch on the bad stuff. So some of the headwinds that Visa is seeing. So number one, and this is a super general run, but there's definitely a push from both consumers and merchants to cut out the middleman. So Visa and MasterCard, because they want to reduce the transaction fees. And we saw this recently with Amazon in the UK dropping the acceptance of Visa credit cards. And obviously this is super, super small in the grand scheme of Visa. It really isn't going to impact them that much. But what is more important is to look at if this is a sign of things to come. And it does show that larger players like Amazon are rethinking their options and they're thinking, how can we cut out Visa? Because Amazon is probably looking at Visa and they're looking at how much profit Visa makes. I mean, they have about 50% profit margin from revenue all the way down to the bottom line. So Amazon's thinking, how can we get some of that? And does Visa really offer that much value that it's worth them, us not trying to disrupt that industry as well? And another interesting trend you're seeing is the growth of the form of payment, which is buy now, pay later, where you have services. Afterpay, which is an Australian company, is a prominent one. They're kind of an up and coming company. And it allows customers to buy for an item now, however small it is, and then make installment payments later on. And then they make money kind of based on the interest differential there. So obviously that is a business that might be threatened if interest rates rise in the future, which does seem likely, but it does show that there are companies out there that are looking at how profitable these businesses are and thinking, how can we get some of that? Now, another headwind in the industry that's worth noting, and this is a much more long-term headwind, but that is cryptocurrency. And I know this may be controversial because everyone has different opinions on the efficacy of cryptocurrencies and whether or not they will become a part of our everyday lives. But if cryptocurrency use does become widespread, you can't deny that it could steal transaction volume away from the Visa network, which would hurt them. Now, my personal opinion, this is totally my opinion, is that certain cryptocurrencies will become used in the future pretty commonly. Now, I don't think Bitcoin will become widespread just because the energy cost is so significant that it's not actually efficient as an alternative to what we have now. And I'm also aware that you can't really compare Visa and Bitcoin together because Bitcoin is its entire transaction processing infrastructure, whereas Visa is just one player in the market in terms of the entire infrastructure. But the point is that Bitcoin just uses way too much energy. And in a world where energy is going to become increasingly scarce in the future, it's just not the best alternative. So here is one article that I found, and it was a study done. I didn't look into exactly how they did the study, but let's just take it for what it is. And they're basically saying that Bitcoin's energy consumption is less than half of the traditional banking system. So they're trying to paint it in a positive light here. Now, I'm not exactly sure they calculated it, but again, let's just assume it's perfectly correct. But if that's how much energy that Bitcoin uses today, and Bitcoin is not really used commonly for transactions, I mean, it's really just used for speculation at this point. Imagine how much energy it would use if it replaced the banking system and it became everyone's primary method of payment. It just does not seem viable to me. And I think there's other cryptocurrencies that would do a better job. And you can't forget about the fact that a big reason why people continue to use credit cards is because they offer incentives, right? You get cash back, which is something that Bitcoin and other major cryptocurrencies currently don't have to offer. So that's something that I think will keep people using credit cards into the future. Okay, now let's move on to looking at Visa's financial history, and then we'll get into the DCF model. Okay, so here is 10 years of financial history for Visa, and we'll start by taking a look at revenue growth, because that's another key input in a DCF model. And we can see it's kind of been growing at rates. So it was growing a bit faster in the earlier years. It then slowed down a bit here. Pretty big growth from 2016 to 2017. But I'd say overall, it would be about 10% a year, maybe a bit higher. Now, it did shrink in 2020. Keep in mind their year end is September 30th, 2020, but then it grew another 10% year over year. So that shrink was probably just due to lower economic activity, as we all know of that thing that happened in 2020, but it recovered pretty strongly. Now, we already looked at their operating margins and we noted how they were much lower, and then they grew, and they kind of got to this point around 66, 67, where they've kind of hovered for a while. So Visa is what you would call a business with high operating leverage. So operating leverage essentially just refers to the breakdown of a company's cost structure between fixed costs and variable costs. So Visa has very low variable costs. I mean, their cost of goods sold are extremely low. Gross margins are 96%. So most of their costs are fixed costs like marketing, staffing, that type of thing. So once they achieve a certain level of sales volume that covers those costs, any additional sales are mostly profit because they've already covered their fixed costs. So the more sales they generate, the higher operating leverage means that they're going to see much higher profit growth. So we can see if we take a look at their operating margins, we go back, let's go back even a bit further. Let's see. So if we go back to 2006, which is a long time ago, operating margins were 26%. That's because their sales volume was lower. So then as their sales volume got higher, they became increasingly profitable until they got to this point where we're seeing here of margin 66, 67. So that's kind of how Visa is. And I think based on that trend, we can extrapolate that into the future. And I don't think we'll project them to have an operating margin anything higher than, say, 67.5%. Now, if we take a look at the balance sheet, one thing we want to take note of is the trend in their cash and cash equivalents and short-term investments, because these are also inputs in the DCF model. So in 2012, they had $2 billion in cash. We fast forward to today, about $16.5 billion. And it's especially gotten higher in recent years. So 2019 to 2020, it jumped quite a lot. So this company's stacking a lot of cash, and their short-term investments currently sits around $2 billion. So that's gone down a bit in the recent years, but currently it's about $2 billion. And we also want to take a look at their debt. So let's see how their debt has kind of evolved as the company has grown in the last 10 years. So we'll look at long-term debt, and we can see they actually had no long-term debt until they took on about 16 billion in long-term debt in 2016. They took on a bit more in 2020, and then it looks like they paid some down as it went down to from 21 billion to 19 billion here. And I think it makes sense for a company like Visa to take on debt, because if you have this much cash and you're such a profitable company, using debt is a very low cost way of raising financing, because the company probably has an extremely high credit rating just based on the fact that they have very low liabilities, they generate a ton of money, and they have a lot of cash on their balance sheet. So the interest rate that they're going to get on this debt is probably quite low. So it's super cheap financing. Now we head over to the cash flow statement and we can see their depreciation amortization expense is extremely low. I mean, it's $271 million for a company that's doing 12 billion in net income. That is extremely low. And if we scroll down a bit and look at their capital expenditures are quite minimal. They've averaged about 700 to 750 million in the more recent years. So that's the beauty of this company, is when it comes to reinvesting back in their network, they don't have to spend capital expenditures to do it. They really do it through the client incentives. So when doing the DCF, we can just assume that capital expenditures will remain at this rate, maybe go up slightly in the future years. Okay, so now let's get into the DCF model, and we'll start with the cost of capital here. So I determined cost of equity is always using the capital asset pricing model. So I used a 2% risk-free rate, a 6% market risk premium, and then unlevered beta of 0.98. So that gives us about an 8% cost of equity. Now, cost of debt, I just calculated this super simply as just kind of to get a proxy of what it is. So I just took their most recent interest expense over their book value of debt on their most recent financial reporting phase, and that gave about 2.45%. So that's actually a very low cost of debt. And the reason it's so low is because they have a very strong credit rating, as I discussed previously. Now, their capital structure is very primarily through equity. They have a market capitalization as of making this video of about $446 billion, and then just about 21 billion in debt. So it's about 95.5% financed through equity. And then here's the tax rate here, which I just calculated it very simply. Again, just took taxes paid plus the income before taxes in their most recent income statement, and it gave about 23%. There are more in-depth methods you can use to calculate a more accurate tax rate, but I just wanted to use this one as a proxy. So we get a 7.63 cost of capital with those numbers. And then we will always want to compare cost of capital to return on invested capital. This gives you a good idea of how good the company is at generating shareholder value. You want to see a large difference with return on invested capital being much higher than cost of capital, which in this case it is. Visa has a very high return on invested capital. Anything above 20% is quite good. So the 5-year average is 21.5%. And then in the last 12 months, about 23%. So that's definitely a good sign to see. It means Visa, as it stands today, is doing a good job generating shareholder value. So now I'll move on to the DCF model. So I'm not going to go too in depth explaining the mechanics of this model. I did a whole entire 50-minute video on that. So just go back and check my channel if you want to actually learn how to build out a model like this. And in that video, I actually linked the spreadsheet I'm using here. So if you want access to that, just go to that video, watch it, you can learn it, and you can use the spreadsheet as well. But basically we have assumptions here, and it's going to determine the fair value, so the intrinsic value. Now, one thing I do want to say here is this model isn't made to be my predictions of the future of Visa. What I'm trying to do here is put in assumptions that lead Visa to be fairly valued. So the conclusion of this DCF model will be that they're approximately fairly valued. And then we can look at what future expectations for Visa is currently priced in. Because then if you want to make money on this investment, they would have to outperform what's currently in the model here. So I'll just run through the assumptions now. So I have 10% revenue growth, and this is a 10-year model. So I'm assuming 10% revenue growth every year for the next 10 years, and then they hit the terminal phase, which is when they just kind of grow at about 1%, which I used 1% as the perpetual growth rate here, because as we saw, approximately half of their revenue kind of comes from it will grow with inflation, right? And we can expect inflation to be about 2%, whereas the other half is just volume based. So if we expect half of it to continue to grow at the rate of expected inflation, then 1% kind of makes sense. But at 10% revenue growth per year, this gives us revenue in 2031 of $62.5 billion. And as of their most recent year is about 24 billion. So that's what you have to understand. We're saying that Visa is going to go from 24 billion to 62.5 billion in 2031. So that is strong growth. Now, their EBITDA margin I have at 66% for next year in 2022, but it is growing at 0.15% a year. And I explained why that was. They earn higher fees on international transaction processing. So by making that assumption, we're assuming that international transaction processing will grow as a source of revenue, which will lead to higher EBIT margin or operating margin. So that's the logic behind this increasing. So it gets to 67.5% in 2031. We could even make that a bit higher. I think overall this assumption is actually kind of in the middle. It's not too optimistic, not too pessimistic. We deduct taxes, we deduct capital expenditures, which are minimal, which I just kind of estimated. Then you add back depreciation, amortization, and then deduct investments in working capital, which I just estimated the investments in working capital. If you go to their financial statements, this number is going to be a lot larger than what I have here. And the reason for that is because the reason why it's so large is because of how they're accounting for the client incentives, which I've already accounted for that with the revenue here. This should really be net revenue because it's the revenue they earn less the client incentives. So that's how I'm accounting for it here. So this gives us free cash flow to firm, and then prorate that for the year. And then from there, we get the discounted value. And then if we continue to go down, we get the enterprise value, which is the sum of all the future free cash flows that we're expecting, which consists of this plus the terminal value, which the terminal value is over here. And then I then add cash and investments of 35 million, which was just an estimate I made. It could be higher than that. It could be lower than that. Overall, it doesn't impact the end result too much. But then you deduct interest-bearing debt, which I estimate to be 30 billion. It's about 21 billion as of now. So I'm assuming it's going to grow a bit into the future. Then also deduct preferred shares. And then you get the value of equity. And then divide that by shares outstanding, which I projected they're going to buy back about 2.5% of shares per year, which they might buy back more than that, maybe low. I think that's a bit of a mid-level assumption there. But the end result is we get a fair value per share of $232.91. The current price per share is about $212. So based on that, it's about 9% undervalued. So if you were to buy this stock and hold it for, say, 10 years, then the annual return you would get would be about the cost of capital, maybe a bit higher because we are projecting it to be undervalued. So it'd be about 8% a year throughout those 10 years. So at 10% revenue growth and this type of EBIT margin here, then Visa would still be a buy, not a screaming buy, but a buy if you believe these numbers. However, if we assume that they don't achieve 10% revenue growth every year and say only 8.5, then we can see that how that changes the model. We go down, now they're not undervalued. They're actually overvalued on that basis. So let's say it's 9%. Let's just play around with the numbers. They're closer to fairly valued at 9%. So this is where you can make a decision. You can play around with the numbers and say, okay, what future scenarios of free cash flows are currently priced into Visa's market cap? And if you want to earn a market-beating return, then you'll know that Visa has to beat those projections. They have to have more sales, more operating income, more free cash flow, et cetera. And then you can determine whether or not you think it's likely that they will exceed those expectations, in which case you can expect to earn a market-beating return, which, again, that's the goal at the end of the day. So Visa is definitely a great company, right? There's a lot to like about it. And we talked about the different tailwinds in the industry, like third world countries becoming increasingly cashless. Also some headwinds, such as potentially cryptocurrency stealing some of the transaction volume there, as well as the push for retailers, powerful retailers like Amazon, to cut out the middleman and decrease transaction volumes. So there's a lot going on in the industry. But at the end of the day, Visa is a great company that is priced as if it's a great company. So you'd have to put in your own revenue growth assumptions and EBIT margin assumptions and decide for yourself whether or not you're comfortable buying into a company like Visa, given what you can reasonably expect to happen in the future for them. So anyways, guys, that's my thoughts on this company. I hope you did find this video interesting and you found it useful. Please leave a like if you did, and subscribe if you're new to the channel and you enjoy this type of content. And with that in mind, I'll see you in the next video.